Welcome to the Deep Dive, where we break down complex reports and give you the key takeaways. Today, we're diving into EVN's latest earnings call.
That's right, covering the first half of their 2024-25 financial year.
And the main message coming from management, results were solid and in line with expectations.
Yeah, pretty much. And the numbers, well, it seems to back that up. Group net profit landed at $250.6 million.
Okay, $250.6 million. How does that compare?
It's a big jump, actually, up 26% compared to the same period last year. Really quite significant.
Wow, 26%. Yeah, that's definitely solid. And I saw other key metrics were up strongly, too.
They were. Group EBITDA, that was up 20%, hit $513 million. And Group EBIT climbed even more, 28% to $335 million.
Okay, strong performance across the board then. Revenue, too.
Revenue also saw a decent increase, 6.6% higher, reaching 1.7 billion euros.
So the overall feeling from management is that these results show stability, resilience, gives them confidence for the full year.
Exactly. That's the message they're putting out there.
All right, let's dig into how they got there. What were the main things pushing results up?
Well, a big factor, maybe unsurprisingly, was the colder winter. That really drove up demand, especially, in the Austrian network and for district heating.
More heating needed. Makes sense.
Precisely. And we also saw some positive effects from volumes and prices in their network and supply businesses down in Bulgaria and North Macedonia.
Okay.
And another sort of specific boost came from insurance compensation. They received payments related to those flood damages in Lower Austria last September.
Ah, right, the floods. So insurance helped offset that.
It did. And their investments in other companies, the ad equity ones, also did better overall. Our ROCK and EVN Carroll contributed more strongly, although Infant Power Plants was slightly down.
Okay, so quite a few tailwinds there. But it wasn't all positive, right? What were the negative impacts?
No, definitely not all smooth sailing. There were headwinds. For one, lower generation from renewables.
Really? Even with them expanding capacity?
Yeah, just less wind and water available in Austria this period, apparently. So lower volumes from wind and hydro. And on top of that, the market prices they got for the electricity they did generate were also lower.
Double whammy there. Less volume, lower price.
Exactly. Then you had some negative impacts from hedge valuations compared to last year.
Right, the hedge valuations. Can you quickly unpack what that actually means for listeners? It sounds a bit technical.
Sure. Yeah, basically it's about how the value of their financial hedges changes on paper during the reporting period. Hedges lock in prices, right, to reduce risk. But accounting rules mean changes in market prices relative to those locked-in prices can create these non-cash gains or losses in the reported profit.
So it's an accounting thing, not necessarily reflecting the physical energy delivery at that moment.
Correct. It can cause swings year on year, like it did here. Also, higher procurement costs buying energy to sell on, particularly in Southeast Europe's regulated supply business, squeeze things a bit. And while insurance helped, there were still increased costs for actually doing the flood repairs. Plus, personnel expenses were up, more staff, wage increases.
And they mentioned something about comparing operating expenses year on year being difficult because of some one-offs last year.
That's right. Last year's figure included a specific receivable impairment in the international project business, and also that energy prices contribution charge. Take those out, and the comparison isn't straightforward. Oh, and the financial result, interest costs, things like that came in at minus 29 million.
Got it. Okay, let's shift to the balance sheet. How's their financial health looking? Net debt.
Net debt stood at 1.3 billion at the end of March. Now, that is up from September 2024.
Why the increase?
Management pointed directly to the investment program. They're spending more, so borrowing has increased to fund that build-out. It's expected.
Makes sense. What about gearing?
Gearing ratio is 19.7%. They stressed that even with higher debt, they still have good financial flexibility. Still got 85 million in undrawn credit lines available.
And their credit ratings. That's always key.
Still solid. Moody's reaffirmed their A1 stable rating in April, and Scope just gave them an A+ stable again in May. Maintaining those solid A category ratings is a key goal for them. They use a metric, net debt to SFO, to manage that balance between investing and keeping the balance sheet strong.
Good. So speaking of investing, what was the actual CapEx spend in the first half?
318 million, and that's up 23% year on year. Right on track with their plan, they said.
And that plan is pretty ambitious, right?
Yeah, it's huge. They're aiming for about 900 million euros per year in investment, right through to 2030.
$900 million a year. Wow, where's all that investment going?
The usual suspects for utility and transition, really. Big focus on network infrastructure poles, wires, pipes, lots into renewable generation capacity, expanding e-charging for electric vehicles, and also securing drinking water supplies.
And mostly focused geographically.
Heavily focused on Lower Austria. About 75% of that $900 million annual spend is planned for there.
They also talked about batteries, didn't they? Large-scale storage.
They did. They're looking seriously at large battery systems, planning a 70 milliW project at one of their sites, the TI location.
Why are batteries becoming so important now?
Well, as you get more renewables like wind and solar, which aren't always generating, batteries are crucial for balancing the grid. You store excess power when it's sunny or windy, release it when it's not. Helps manage load, optimize the network, and it could even help wind and solar act more like flexible virtual power plants.
Interesting. Okay, shifting again, ESG and climate targets. Any news there?
Yeah, they got their new CO2 reduction targets validated by the Science Based Targets Initiative, the SBTI.
And what does that validation mean?
It means their targets are now officially aligned with the tougher 1.5-degree goal from the Paris Agreement, more ambitious than their previous ones. And they hammered home again that expanding renewables is absolutely central to hitting those targets.
What are the numbers on that renewables expansion?
They've passed 500 millidollars of installed wind capacity and over 100 millidollars peak of solar PV. The targets for 2030 are even higher. 770 millidollars wind, 300 millidollars peak solar. So, still a lot of building to do.
Okay. Let's look at the outlook. Did they confirm their full-year guidance?
They did. Group net result guidance is still $400 million to $440 million. That's assuming, no major regulatory or energy policy surprises.
And they made a point about this range, didn't they? About it being a step up.
Yes, this was a key message. They emphasized that this $440 million range represents what they now see as the new normal earnings level for the company. A substantial step up from just a few years ago when the baseline was more like $250 million.
So essentially doubling their view of the sustainable underlying earning power. That's significant.
It really is. They also gave the usual reminder about seasonality. Energy demand is much higher in winter, so H1 results are always stronger than H2. You can't just double the first half figure.
Right, good point. And dividends.
Policies unchanged, targeting at least 82 cents per share and aiming for a payout ratio of around 40% of adjusted group net results over the medium term.
Okay, let's quickly run through the segments. Energy for supply and heating. How did volumes look there?
Bit of a mixed bag. Gas and heat demand were up thanks to the cold, but electricity sales volumes actually dipped year on year.
Any reason why?
They mentioned lower sales to industrial customers in Germany. In Austria, things like heat pumps, e-mobility, and the weather helped offset some competitive pressures, but overall electricity sales volume was down.
And revenue in that segment?
Revenue fell, down to $372 million, mainly because of lower prices for their own generation, gas trading effects, and those hedge valuation swings we talked about. The heating business, though, did benefit from the cold.
Okay, and operating costs?
They decreased, pretty much in line with lower market prices for energy.
What about that at-equity supply company, EVN KG? They mentioned a turnaround.
Yeah, the operational turnaround is apparently on track. But there was a specific one-off accounting effect, a reversal of something called ACL from the previous year, which meant EVN KG actually reported a loss of $11 million for the half. Still better than last year, but a loss nonetheless.
So does that impact the segment's full-year outlook?
It might. Because of that one-off, they flagged that the energy segment's full-year EBIT could come in slightly below the $50–60 million range they'd previously guided. But they stressed the underlying operations are improving as planned.
Got it. And within energy, they highlighted e-charging, right?
They did. They're the market leader in Austria, and they announced a big new partnership with the furniture retailer XXX. They're putting in 600 charging points across nearly 100 stores.
Seems like a strategic area for them.
Definitely.
Yeah.
They see e-mobility as key for integrating renewables, maybe even using EVs for grid services in the future, like bi-directional charging. Thinking ahead.
Okay, moving to generation making the electricity. Volumes were down.
Yeah, down 10%. Again, less wind, less water flow in Austria hitting the renewables. Interestingly, their TI thermal plant was called on more often for grid stability.
Shows conventional power still plays a role.
For now, yes. Revenue and generation was down to lower prices and lower volumes, plus impacts from flood damage repairs at a waste plant and lower earnings from their infant investee.
And the outlook for generation?
Confirmed to be weaker this year. Lower market prices mean revenue will drop significantly. So EBIT will be lower than last year, probably in a 25-35% margin range, assuming average weather.
Right. Now, the network segment, the pipes and wires, how did that do?
That was stronger. Volumes up for both electricity and gas distribution, partly the cold weather again, but also heat pumps, e-mobility, and that extra use of the TI plant pushing electricity through the grid.
So volumes up, revenue.
Revenue increased too, driven by those volumes, and also higher regulated electricity network tariffs. Operating expenses rose as well, mainly due to higher upstream grid costs.
But overall, EBIT for networks was up.
Yes. EBIT increased nicely to $121 million. Higher operational earnings more than offset increased depreciation from all the investment they're doing. The full-year outlook here is more positive. Investments are growing the regulated asset base, which supports future earnings, and the H1 volumes and tariffs help too.
But they added a caveat about volumes.
Yeah, under Austrian rules, those positive volume effects we saw in H1 will likely get clawed back in future tariff settings. So they can't rely on just volume growth long-term. Regulation evens it out.
They also mentioned household tariffs in the Q&A.
Right. They acknowledge tariffs have gone up a lot recently, but they expect future increases to be more gradual. And they confirm that the planned $450 million annual network investment is still realistic, no major inflation-driven increase foreseen right now.
Okay. Down to Southeast Europe, Bulgaria, North Macedonia.
Volumes were up there too for network and energy sales. Again, cold weather in Bulgaria was a factor.
Revenue followed.
Revenue did increase to $891 million thanks to volumes and prices.
Yeah.
But, and this is a big but,
There's always a but.
it was largely offset by regulatory adjustments. The regulator in Bulgaria basically corrected for past positive earnings effects based on their mechanism.
So clawbacks, essentially. How did that affect profit?
Segment EBIT dropped significantly down to $34 million. But management said this was expected, in line with guidance, due to these regulatory adjustments. They now expect full-year EBIT for the segment to be at the lower end of the $60-90 million medium-term range because of this Bulgarian correction. But overall, still in line with long-term expectations for the region.
Okay, understood. Finally, the environment segment and that planned sale.
Right, the sale of parts of the WTE international project business to Strabag. Negotiations are ongoing. It's complex, so the timeline slipped a bit, but both sides are still committed and working towards signing soon. No major change expected to the deal's economics.
And how does that affect the reporting?
Because it's held for sale, it's reported under IFRS 5 discontinued operations. So the P&L you see for the segment only includes the bits they're keeping or have already dealt with.
Which are
The lower Austrian drinking water business, the Zagreb and Prague joint ventures, the deconsolidated Budva plant, and effects from the already completed Moscow plant sale.
Okay, so just that slice. What were the results from that slice?
$14 million profit in H1 from these discontinued operations, compared to a restated $12 million last year.
And the outlook for environment?
They expect improvement this year versus last, but mainly because last year had a big negative one-off, that $22 million write-down related to Budva. The actual guidance for the activities not being sold is for EBIT between $10 and $20 million for the full year.
Okay, let's pull this all together. For you listening, what does this H1 update really signal?
Well, first, it strongly backs up that confirmed full-year guidance. And maybe more importantly, it validates that big step up in their view of the normal earnings level, that $440 million range. That seems pretty embedded now.
And looking broader at the sector.
You see the typical themes, weather and market prices hitting generation, that's common. The crucial role of regulation tariffs, taxes like the new Austrian one, and the huge investment needed for the energy transition, which EVN is clearly undertaking.
So key signals from the call. Management seems confident overall, despite some specific segment issues this half. The investment plan is huge and focused on networks and renewables, but also these strategic bets like e-charging and batteries. And they're constantly dealing with the regulatory side.
Yeah, that new Austrian utility tax, for instance. They estimate a low single-digit million euro impact for this year, but details are still pending. And they're pushing for that new electricity act from the government.
So for you, the listener, it points to a company with a more predictable, higher earnings base now, underpinned by that growing regulated network, but still facing volatility in generation from weather and prices, and always subject to the risks and opportunities of regulation and policy as they invest heavily in the transition.
It's that classic utility balancing act.
Right. Which brings us, inevitably, to our completely non-financial advice segment.
Emphasis on non-financial advice. Seriously, this is just talking points, pure speculation for fun. Don't trade based on this.
Okay, disclaimer firmly noted, but let's throw out an idea, maybe a bit outrageous based on today's discussion. How about this? Go long EVN. Betting on that stability, the growing regulated base, the higher earnings floor.
Okay.
And at the same time, maybe short a pure play merchant renewable generator, one that's really exposed to the kind of wind, water, and price volatility that, well, hit EVN's own generation segment this half.
The relative value play. So the thinking is bet on EVN's diversification and regulated stability.
Exactly. That confirmed guidance, the higher baseline, the massive network investment that provides a solid foundation.
While simultaneously betting against the pure exposure to volatile generation, which we just saw can be tricky, even for EVN's own assets.
Right. You're essentially playing the stability of the diversified utility model against the pure merchant risk in renewables. It kind of cuts against the simple, all renewables are great all the time narrative, focusing instead on the value of that SETI infrastructure backbone and the growth potential in areas like e-mobility and storage within that structure.
It's definitely a thought.
Yeah.
An outrageous one, perhaps.
Yeah.
But based on contrasting the different parts of EVN's own results, again, absolutely not financial advice.
Absolutely not. Okay, to wrap things up, EVN delivered solid H1 results, confirming guidance in that higher baseline earnings level. The big story continues to be the massive investment program driving network and renewable growth, plus strategic moves into areas like batteries and e-charging, all while navigating the ever-present regulatory factors.
And a final thought, perhaps, for you to mull over. As EVN pours billions into regulated assets, building that stable base, how will that ultimately balance out the inherent volatility in their generation business and the shifting sands of regulation to drive long-term value?
Something to consider. Thanks for tuning in to the Deep Dive.